What if you could invest like Warren Buffett, without billions or decades of experience? Today we'll break down 3 powerhouse companies that Buffett himself has poured billions into. These aren't just stocks, they're pillars of the modern economy, with fortress-like advantages and the potential to build real, lasting wealth. We'll cover a global payments leader, a consumer tech giant, and an insurance powerhouse, all embodying Buffett's core investing principles. This isn't just another top stocks video. It's a masterclass in value investing, straight from the Oracle of Omaha's playbook. We'll dissect their moats, financials, and long-term vision, so grab a pen because these insights could be worth a fortune. Like, share, and subscribe so you don't miss the next big investing update. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Let's start with Visa, ticker symbol V, a company that's essentially a toll booth on the global economy. Every time money moves, Visa is there, quietly taking a small cut, no matter where you are in the world. It's a business model that's as elegant as it is powerful, and it's woven into the fabric of daily life for billions of people. Visa doesn't lend money or take on credit risk. Instead, it runs a massive, secure network connecting banks, merchants, and consumers, taking a tiny fee from every transaction. Think of Visa as the digital rails that make modern commerce possible, ensuring payments are fast, safe, and reliable. That tiny slice adds up fast. Visa processes trillions in payments every year across more than 200 countries. The sheer scale is mind-boggling. At any given moment, millions of transactions are zipping through Visa's network, from small purchases at a corner store to massive corporate payments. As the world moves from cash to digital payments, Visa's growth runway just keeps getting longer. The shift is global and unstoppable. Emerging markets are leapfrogging straight to digital, and even in developed countries, cash is fading fast. Every tap, swipe, or online checkout is another win for Visa. What Buffett loves most? Visa's economic moat. Its network effect is nearly impossible to replicate. Merchants accept Visa because everyone uses it, and everyone uses it because merchants accept it. This creates a powerful feedback loop that keeps competitors at bay and cements Visa's dominance. The result? A self-reinforcing loop of dominance. The more people use Visa, the more valuable the network becomes, attracting even more users and merchants. It's a virtuous cycle that's been compounding for decades. Visa's financials are stunning. Profit margins around 50%, thanks to an asset-light, highly scalable business model. Few companies can match this level of efficiency and profitability, especially at such a massive scale. As payment volumes rise, costs barely budge, so more revenue turns into pure profit. This operating leverage is a dream for investors, allowing Visa to grow earnings faster than sales and deliver outsized returns. This operating leverage lets Visa reward shareholders with dividends and buybacks, compounding value over time. The company has a long track record of returning capital, making it a favorite among long-term investors. Even during downturns like the 2020 pandemic, Visa's business proved resilient and bounced back quickly. When spending slowed, Visa tightened its belt, but as soon as the world reopened, transaction volumes surged back, highlighting the company's adaptability and essential role in the economy. Visa isn't standing still. They're innovating with contactless payments, enhanced security, and real-time payment services, and expanding into business-to-business payments. The company is constantly evolving, investing in technology to stay ahead of fraud and meet the needs of a digital-first world. Rather than fight fintech disruptors, Visa often partners with them, keeping its network at the center of global commerce. By collaborating with startups and established players alike, Visa ensures it remains indispensable, no matter how the payment landscape shifts. The risks, regulation, and overpaying for the stock. But Visa's global scale and adaptability make it a survivor. Regulatory scrutiny is always a concern, but Visa's compliance infrastructure and global reach help it navigate complex environments. Buffett's principle: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Visa is the definition of a wonderful company. Its consistency, reliability, and growth potential are exactly what Buffett looks for. It's a set-it-and-forget-it investment, stable, growing, and deeply embedded in the global economy. Whether you're buying groceries, booking a flight, or shopping online, Visa is quietly working in the background, collecting its toll. Visa's management is shareholder-friendly, returning capital through buybacks and dividends. They're disciplined, focused on long-term value, and have a proven track record of smart capital allocation. The company's wide moat, secular tailwinds, and incredible profitability make it a Buffett favorite. Few businesses are as protected from disruption, and even fewer have such clear long-term growth drivers. You don't need to check the price every day. Owning Visa is like collecting a toll on global spending. As the world gets wealthier and more connected, Visa's slice of the pie just keeps growing. To recap, Visa's moat, digital payment tailwinds, asset-light model, and consistent growth make it a compounding machine. It's a rare blend of safety and growth with a business model that stood the test of time. It's a textbook Buffett stock, simple, powerful, and built to last. Visa's story is one of quiet dominance, compounding value year after year. With a market capitalization of $679.78 billion and earnings per share of $11.29, Visa maintains a solid P/E ratio of 30.88. For fiscal year 2024, the company pulled in $35.93 billion in revenue, delivering a net income of $19.74 billion. That's an exceptional profit margin, underlining Visa's incredible operating efficiency in a digital-first economy. Its performance remains strong as global transactions shift increasingly toward cashless and mobile platforms, making Visa an integral part of the global financial infrastructure. If you want a stock that works while you sleep, Visa should be at the top of your list. It's the kind of business that keeps delivering, day in and day out, no matter what's happening in the headlines. It's not just a credit card company, it's the infrastructure of modern commerce. Without Visa, the global economy would slow to a crawl. That's the power of being the backbone of payments. That's why Visa is a no-brainer for long-term investors. It's a rare combination of resilience, growth, and shareholder returns. Next, let's look at a company that's redefined what it means to build a loyal customer base. If Visa is the backbone of commerce, this next company is the heart of consumer loyalty. Ready for the ultimate ecosystem? Let's talk Apple. Transition to next scene. Next up is Apple, ticker symbol AAPL, the crown jewel of Berkshire Hathaway's portfolio, and for good reason. Apple isn't just the largest holding for Warren Buffett. It's a company that has fundamentally changed the way we live, work, and connect. From its iconic headquarters in Cupertino, Apple's influence stretches across the globe, touching the lives of over 1 billion people every single day. Buffett calls Apple probably the best business I know in the world. That's high praise from the Oracle of Omaha, who spent a lifetime searching for companies with enduring competitive advantages. For Buffett, Apple isn't just another tech stock, it's a business with a moat so wide it's nearly impossible for competitors to cross. But he doesn't see it as a tech company. He sees it as a consumer brand with an unbreakable ecosystem. Apple's products aren't just gadgets, they're woven into the fabric of daily life, seamlessly connecting people, work, and entertainment in a way that feels almost magical. The iPhone is just the gateway. Once you're in for good. AirPods, Apple Watch, iCloud, App Store, Apple Music. Each product makes the others more valuable, locking customers in. It's a virtuous cycle. The more Apple devices and services you use, the harder it is to leave. This interconnected web of hardware and software is what makes Apple's ecosystem so powerful and so sticky. This ecosystem is Apple's fortress. It creates massive pricing power. Apple doesn't compete on price, but on quality, experience, and brand. Walk into any Apple store and you'll see it. Customers are willing to pay a premium for the seamless experience, the elegant design, and the peace of mind that comes with the Apple logo. The result? Premium pricing and fierce customer loyalty. Apple's customers aren't just buyers, they're fans, advocates, and repeat purchasers. Many wouldn't dream of switching to another brand no matter what the competition offers. Apple's services business, App Store, Apple Music, iCloud, Apple Pay, has transformed the company. It's now a high-margin, recurring revenue stream that makes Apple more resilient and less cyclical. These services generate steady cash flow, even when hardware sales fluctuate, and they deepen the relationship between Apple and its users. The razor and blades model: sell the iPhone, then sell a lifetime of high-margin services. Every new device sold is a potential subscriber to Apple's growing suite of services, from music and TV to cloud storage and payments. This model ensures that Apple's revenue doesn't just come from one-time purchases, but from ongoing relationships. Apple's brand loyalty is almost priceless. It's built on decades of design, quality, and trust. From the original Macintosh to the latest iPhone, Apple has consistently delivered products that delight customers and set new standards for the industry. When Apple enters a new market, it instantly commands attention and a ready customer base. Whether it's launching a new device or rolling out a new service, the world watches, and customers line up, eager to be part of the next big thing. Financially, Apple is a cash machine, tens of billions in net cash, the largest share buyback program in history, and a steadily growing dividend. Its balance sheet is a fortress, giving it the flexibility to invest, innovate, and return capital to shareholders. Every year, your ownership stake grows as Apple buys back shares. Buffett loves this. Fewer shares mean each remaining share is worth more, and long-term investors reap the rewards. Risks? regulation and supply chain concentration, but Apple is diversifying and has immense lobbying power. The company is actively working to reduce its reliance on any single supplier or region, and its global reach gives it leverage few can match. The real strength is the ecosystem. Over 1 billion loyal customers, each a captive audience for new products and services. This installed base is a goldmine, providing Apple with a direct channel to market and upsell its latest innovations. The installed base is like an oil well. Apple just keeps pumping high-margin services. As the number of devices in use grows, so does the opportunity to monetize each user, year after year. Buffett's investment in Apple was a masterstroke. He saw the brand, the ecosystem, and the loyalty, not just quarterly iPhone sales. He recognized that Apple's true value lies in its ability to keep customers coming back, generation after generation. Apple's intangible assets, brand, ecosystem, loyalty, don't show up on the balance sheet, but they drive its durable profitability. These are the qualities that make Apple more than just a collection of products. They make it a cultural phenomenon. Don't get lost in product rumors. Zoom out and see the growing base, the services revenue, and the buybacks. The real story is in the numbers: rising cash flow, expanding margins, and a relentless focus on shareholder value. Apple is a digital empire with a fiercely loyal population. Its influence extends far beyond technology, shaping culture, business, and even the way we think about design and privacy. Despite its size, Apple still has room to grow and compound value for years to come. New markets, new services, and new technologies are always on the horizon, and Apple's track record suggests it will continue to lead. It's the ultimate Buffett stock, a wonderful, easy-to-understand business with a durable competitive advantage. For investors seeking stability, growth, and a brand that stands the test of time, Apple is hard to beat. To sum up, Apple's ecosystem creates massive switching costs. Its services revenue is high margin and recurring, its brand commands loyalty, and it's a cash-generating machine. It's a company that not only adapts to change but drives it, setting the pace for the entire industry. With a staggering market cap of $3.02 trillion, Apple generated $391.04 billion in revenue this year, producing a net income of $93.74 billion. The company's earnings per share stand at $6.43, with a P/E ratio of 31.27. Its current share price sits at $201.08, which is just 4.18% below its estimated fair value of $209.49. That slight discount has not gone unnoticed by investors, many of whom still view Apple as a reliable growth and income play thanks to its strong brand, loyal customer base, and expanding ecosystem of devices and services. Whether it's iPhones, Macs, wearables, or services like iCloud and Apple Pay, the company continues to innovate while returning massive value to shareholders. If you want a stock that anchors your portfolio, Apple is it. It's a foundation you can build on, confident that the company's innovation and customer devotion will keep it thriving for decades. Now let's move from tech to a quieter but equally powerful wealth machine, insurance. The next chapter reveals how a different kind of business can quietly build fortunes over time. Ready to see how fortunes are built quietly? Let's talk Chubb. Transition to next scene. For our final stock, we turn to an industry that's quietly powered some of the greatest fortunes in history, insurance. It's no secret that Warren Buffett has long called insurance his favorite business, and for good reason. Insurance companies, when run well, can build wealth steadily, year after year, often flying under the radar while compounding value for decades. This is the kind of business that doesn't make headlines every day, but it's a cornerstone of many legendary portfolios. The company we're spotlighting is Chubb, ticker symbol CB, a global powerhouse in property and casualty insurance. With a history stretching back over a century, Chubb has grown into one of the world's largest and most respected insurers, serving clients in more than 50 countries. Why does Buffett love insurance so much? It comes down to one powerful concept: float. Float is the pool of money that insurance companies hold between collecting premiums and paying out claims. This money isn't just sitting idle, it's invested, generating returns for the company and its shareholders. Chubb collects billions in premiums every year, and thanks to its disciplined approach, it often holds onto that money for years before any claims are paid. During that time, Chubb invests the float in bonds, stocks, and other assets, earning steady profits on money that technically belongs to policyholders, but benefits shareholders in the meantime. Chubb's business model is elegantly simple but hard to execute. Make money in two ways. First, through disciplined underwriting, collecting more in premiums than it pays out in claims. Second, by investing the float wisely to generate additional income. This dual approach is what sets the best insurers apart from the rest. Unlike many insurers that struggle to break even on underwriting, Chubb has a long track record of generating consistent underwriting profits. This is a testament to its world-class risk management, deep expertise, and a culture that prizes careful analysis over reckless growth. Chubb's focus is on commercial lines and high-net-worth clients, profitable niches where expertise, service, and reputation are everything. Whether it's insuring a Fortune 500 company or a priceless art collection, Chubb's attention to detail and tailored solutions set it apart. Its brand is synonymous with reliability and trust, creating a durable moat that's hard for competitors to breach. Clients stick with Chubb for decades, knowing they'll be protected when it matters most. Leadership is a huge part of Chubb's success. CEO Evan Greenberg is widely regarded as the best in the business, with a relentless focus on profitability, risk management, and long-term value creation. Under his guidance, Chubb has navigated crises and emerged stronger every time. It's no wonder then that Berkshire Hathaway recently revealed a massive new stake in Chubb, a huge vote of confidence from Buffett himself. When the world's greatest investor puts his money behind a company, it's worth paying attention. Chubb's financials are rock solid. The company boasts strong returns on equity, consistent book value growth, and a decades-long record of rising dividends. It's the kind of financial discipline that rewards patient shareholders year after year. The barriers to entry in insurance are enormous. Capital requirements, strict regulatory oversight, and the need for a trusted brand keep most would-be competitors out. Chubb's scale and reputation give it a lasting edge. In a world where risks are rising, whether from climate change, cyber threats, or geopolitical instability, Chubb's expertise in pricing and managing risk is more valuable than ever. The company is constantly adapting, using data and technology to stay ahead of emerging threats. Of course, there are risks. Catastrophic losses can and do happen. But Chubb diversifies across lines and geographies and uses reinsurance to protect itself from the worst-case scenarios. This approach helps smooth out results and protect shareholders from big shocks. Investing in Chubb is a bet on disciplined underwriting, the power of float, and best-in-class management. It's about trusting a team that knows how to grow value steadily even when markets are volatile. Chubb isn't flashy, but it's built to last, just like Buffett's own fortune. This is a company designed for the long haul with a business model that stood the test of time and economic cycles. Chubb's dual-engine model, underwriting profits plus investment income, has quietly become one of capitalism's most powerful wealth creation machines. It's a formula that's worked for generations and continues to deliver today. Chubb boasts a market cap of $114.26 billion and reported $56.01 billion in revenue for 2024. It achieved a net income of $9.27 billion, with earnings per share reaching an impressive $20.95. The company's PE ratio is just 13.61, indicating a more value-oriented stock compared to high-flying tech names. Currently priced at $285.12, Chubb trades at a 20.51% discount to its fair value estimate of $343.59, a notable gap that could attract investors looking for solid returns in a defensive sector. With a strong underwriting record and a diversified global portfolio, Chubb continues to appeal to long-term investors seeking stability, yield, and upside potential in the insurance space. To recap, Chubb operates in Buffett's favorite industry, excels at underwriting, is led by the best CEO in insurance, and now has Berkshire's ultimate stamp of approval. It's a rare combination of quality, stability, and long-term growth potential. If you're looking for a stable, high-quality, shareholder-friendly company to anchor your portfolio, Chubb deserves a close look. It's a stock that rewards patience and discipline, just like the business itself. Sometimes the quietest businesses are the most powerful. Chubb may not grab headlines, but it quietly compounds wealth in the background year after year. There you have it. Visa, Apple, and Chubb, three Buffett-approved powerhouses that embody the principles of great investing. From digital payments and consumer tech to global insurance, these companies represent three pillars of modern industry, each excelling in its own lane, each delivering returns in unique ways. Whether you're chasing innovation, consistency, or value, these companies offer a powerful glimpse into where smart money is flowing. These aren't just stock tips, they're lessons in finding wide moats, strong management, and shareholder focus. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. For exclusive tips and in-depth analysis, join the Stocks Galore Patreon community. Now your turn. Which of these 3 stocks do you think has the best prospects for the next decade? Drop your pick and reasoning in the comments. I read everyone. Like, share, and subscribe for more investing insights. Thanks for watching, and I'll see you in the next one. 8.